With the government taking away the indexation benefit on debt mutual funds, their taxation has now come on a par with that of individual corporate bonds. As a result, many investors are now gravitating towards individual bonds. The coming up of a number of bond investment platforms has also aided this trend. In this interview with Business Standard, Mr. Vijay Kuppa, CEO, InCred Money, speaks about the nuances of bond investing, the advantages, the risks, how to go about mitigating those risks, and much more. Do watch this interview for a complete tutorial on bond investing. Good morning, Mr. Kuppa. Welcome to our show.
Good morning. Thank you for having me over.
These are very interesting times for bond investing, especially after the government took away the indexation benefit from debt mutual funds. Both debt mutual funds and individual bonds now enjoy similar tax treatment. Plus, you have so many bond platforms coming up. Only today in the newspapers, it said that the bond platforms are thinking of coming together and forming an AMFI-like body. So I thought this was a good time to discuss with you how retail or HNI investors can go about investing in bonds. My first question to you is, after the indexation benefit for debt mutual funds went away, have you seen more investors gravitating towards individual bonds?
Yes. So actually, so just to quickly tell you about the tax benefit that has gone. So before 31st March, on debt mutual funds, your long-term taxation, that is if you held it for greater than 3 years, taxation was 20% with indexation benefit. So which pretty much brought your effective tax rate to lower single-digit numbers. But in this budget, that was taken away, and now you're taxed at your marginal rate, which is 30-35%, depending on the tax rate that you fall in. So after this tax arbitrage went away, we are seeing advent of interest in individual bonds now, because individual bonds typically have a higher interest rate of offering. And but on a post-tax basis, they were not as lucrative as say mutual funds earlier. But now with that benefit gone, individuals are flocking towards it, both on the HNI space and also on the retail side, which is the smaller individual investors.
When you invest in a debt mutual fund, you get the benefit of diversification. Also, you have a fund manager and his team of analysts who select the bonds for you, and they also monitor those bonds. Why then do people want to invest in individual bonds? What are the advantages?
Right. So actually, that's right. When you go via debt mutual fund route, usually there is a very sophisticated team of fund managers and research analysts who help pick a portfolio of bonds, which gets you that benefit. But they also have certain cons in terms of lower yields because of both expense ratios, which are fairly high, anywhere between 1% for a direct plan or 1.5% for a regular plan, and all debt mutual funds have to honor redemptions on a T+1 basis, which means that they have to give the investor his money back on a T+1 mode. So what fund managers and all tend to do is, and that's a very short time of turnaround to be able to provide that liquidity. So they always invest in liquid assets, which tend to be of lower yield, and also keep some cash and cash equivalent. So all put together, the yield on a debt mutual fund in a credit fund is not that big. So the main advantage of buying individual bonds is, of course, the higher returns that you're able to get. Now, of course, picking a individual bond needs a certain amount of knowledge and a certain amount of analysis that you need to do. But I think that's where platforms are emerging today, including InCred Money, which is one, which have a large team of credit analysts who have a team of people who do this research day in and day out and are able to curate bonds on the platform and give the ability for investors to do some analysis themselves and invest in it. So in sum, I would say primary advantage is the higher yield. Second is, of course, the slightly more predictability of returns, because when you invest in a particular bond, you know exactly what you're investing into. So it's similar to a stock versus a mutual fund. You know what you're getting into, what the coupon is, and what the payouts are. So you have a lot more certainty of it. So if you're someone who doesn't need immediate liquidity and you can wait out the tenor of the bond, then there are quite a good number of merits of investing in individual bonds.
What are some of the disadvantages and risks when you invest in a standalone bond?
Right. So in bonds or in any fixed income instrument, you typically have three main types of risks that you need to be aware of. The first and foremost is a credit risk. So credit risk means that the bond that you're holding, the issuer whom you have lent your money could default, or he could get into some problem and he cannot honor his payments of the debt. So this is the biggest risk that bondholders hold. The second risk is called interest rate risk, also known as duration risk. So interest rate risk is that because of changes of interest rate in the economy, when the RBI increases or decreases rates, the prices of these bonds fluctuates. So you could be exposed to that volatility. It's called a market risk also. You could be exposed to that volatility, and that is one more risk that you need to be prepared for. The third risk is liquidity risk. So India doesn't have a very deep credit market as compared to an equity market where you have fairly nice liquidity. So if you want to exit your bonds at any point of time in between your holding period, it's not that easy to do. And hence, that's a bit of a risk that your money could get locked up for some point of time. So these are the three main risks that investors face when they are investing in bonds.
So we'll discuss each of these points in further detail later. My next
Sure.
question is, most investors just go by the returns that a bond is offering. As soon as they see in the newspaper advertisements that there is a bond offering 10% return or so, there is a lot of excitement around it. Is that the way to invest in bond? What else does one look into?
So actually, I mean, that is the way it is done, but it's not the right way. What you need to do is first understand what your risk appetite is. Like investors have differing risk appetites in terms of what kind of risk they're able to take. And even in bonds, just as in equities, you have a large cap and a mid cap and a small cap. Similarly, in bonds, you have like a AAA rated bond, then you have like a triple B rated bond, and then you have like a C or D rated bond. So knowing what rating a bond has, what is the risk of that bond is very important. That's the credit risk part of it. The second is knowing what the duration of that bond is. Is it a 1 year bond, or is it a 3 year bond, or is it a 10 year bond? So knowing the time horizon, because you could be locked into that. And of course, the third is knowing the interest rate movement, or where the interest rates in the economy are and how that could affect the price of your bond. So investors should always evaluate it from a risk point of view, because returns are always good. So look at the risk and see what your risk appetite is. The second thing that investors should see is how are these risks being mitigated by that bond. For example, a lot of bonds are called secured bonds, which means there is some underlying collateral in case of a default event happening. So is it a secured bond? The second piece that they should look at is that what are the interest and capital principal repayment tenors? Like, is it a yearly coupon? Is it a monthly interest coupon? Or is it a quarterly coupon? So that is one parameter. And second is, how is your principal paid out? Is it a payment paid only at the maturity, at the end of the bond tenor? Or do you also have, say, a monthly maturity, quarterly repayments, so on? Ideally, when you're investing in individual bonds, you would want to reduce your risk, and hence more frequent payment schedules are always better. And the third is, of course, the tenor. Especially when investing in credit papers, it's always good to go for a shorter term tenor, because the longer you hold, the more risk you take. So anything up to 3 years is good. So keeping in mind all these factors, investors can then look at the returns of the bond and then decide to whether to invest in it or not.
We often hear about the yield curve. Now, could you explain for our viewers what a yield curve is, and how its shape should or could influence the choice of bonds?
Sure. So yield curve, simply put, is how the yield of different instruments vary over time. So if you take a 1 year bond, what is the yield? If you take a 2 year bond, what is the yield? And then when you plot it on a graph, you arrive at a curve which goes through all these points, and that is known as the yield curve. Typically, your shorter term are at a lower yield in a normally average expected behavior, and your longer tenor have a higher yield. That's because more time, more tenor implies you're taking on more risk, and hence you have to be compensated for that risk. So it has a higher tenor. So a normal yield curve, when they call it a steepening of a yield curve, it means that your shorter term yields of 1 to 3 year maturity are much lower, and your longer term yields of 8, 9, 10 year papers are much higher. Today, what we have seen in the market over the last 2 years is what is called flattening of the yield curve. So what that means is that your 1 year paper and your 10 year paper are very close to each other in their yields. Just to give you a sense of some numbers, as of yesterday, the difference between 1 year and 10 year was less than 15 basis points, so less than 0.15%. So that is very, very flat. Whereas if you just take this 1 year back, the same number between 1 year and 10 year paper was close to 1.5%. Now, why this happens? Normally, your shorter term tenors are influenced by where your RBI sets the benchmark interest rates, your repo rate. So it's influenced by monetary policy. And as RBI is hiking rates over the last 18 months, we have seen that your short term rates have also increased. Your longer term rates, however, are influenced more by the fiscal policy of the government, like what is the borrowing program, what is the fiscal deficit, and so on, and more longer term growth story, not really linked to the short term monetary policy. Now, that has been fairly good and in control over the last 12 months. So the long term rates haven't really gone up as much. And hence, what you have seen is like a flattening of the curve where your short term has risen, but long term has not risen as much. And hence, they're almost at par. So this is called a yield flattening situation that we are currently seeing in the market.
And when the yield curve is flat, then what does the investor do? Does he go for a longer, mid, or shorter tenure bond? What is advisable?
Yeah. So when the yield curve is flat, it basically means that your short-term rates are high. So any fresh investor coming in should ideally pick shorter rates rather than longer rates, because he is not being compensated enough for taking a higher duration in the rate. So at a similar duration, because he's taking on more risk, he's not getting incremental returns. So in such a scenario, investors are better off investing in the shorter end of the curve, which is between 1 to 3 years. Now, however, that being said, another criteria to determine whether you should invest in short term and long term is how the interest rate movement are expected to move. Now, if you think that the rate hike cycle is now over and maybe RBI in some time may start cutting rates, then you are better off investing in longer term tenor. So just by looking at the yield curve, it gives you one information that you should invest in the shorter term, but you also need to consider how the interest rate movements overall are going to be before arriving at a more concrete answer.
The rating of a bond is another very important criterion that one takes into account before investing in a bond. Could you tell us about how ratings should be used by investors to select bonds?
Sure. So there are about 6, 7 different rating agencies in India, and some of the larger ones are CRISIL, ICRA, and CARE Ratings. They rate every bond issue that happens. They rate it and they give their independent assessment. So they are like a third party auditor of an issue, and which is there is a standardized format of, and which people can look at that rating and get a sense of how risky that bond is. Because for an individual to do all that research themselves can be challenging because it's quite technical. So this is like a standardized template that these rating agencies give about, and it's like a scale. And depending on where the rating lies on that scale, it shows a indicative risk level attached to that particular issuance. Now, how investors can look at a rating is whenever a rating agency gives out a particular rating on a bond, they also give out a detailed note of explaining why that rating is. So there are strengths, weaknesses, the pros and cons, or why they have assigned a certain rating, and what are the possible risks to that rating. Because rating is not a constant number forever. It is for a particular point of time, given a certain set of financials of that bond issuer and his overall circumstances. Now, with time, either it could get an upgrade, which means that the issuer's profile has improved, or it could go into a downgrade, which means that from the time the bond was issued, something negative happened in that company, and hence it's no longer as worthy as it was when the issue happened. So it's also important to look at that over a period of time. The next thing is ratings are of two types. One, you have a longer term rating and you have a shorter term rating. So short term rating is typically for issuances which are less than 1 year. and longer term are which are greater than 1 year. So for investors, they should look at what the tenor of the bond is and look at that particular rating before deciding to invest. You should not ideally look at the short-term rating when investing in a longer-term paper.
Below what rating does it get very risky to invest in a bond?
Yeah, so each rating agency has its own scale. So typically, I can tell you for say one, let's take CRISIL, which is the largest rating agency. So their ratings go from AAA, AA, A, triple B, double B, B, C, and D. That is their scale of rating. Anything that is double B and below is called non-investment grade, and anything that is above that is called investment grade. So investors should see that they are at least a triple B minus, triple B or plus higher than that before investing. Double B and below is called non-investment grade, and it should be avoided. In some common parlance, that is also called a junk rating.
And all rating related information or updates on ratings, are these available in the public domain? And can one just go to CRISIL's website and look up these ratings?
Yes, it is available in the public domain, and it is updated also publicly available. So you can just type CRISIL rating and a particular bond issuer, and you will get to know the details of it.
Now, during the credit crisis of 2018, we saw that ratings of many bonds got changed overnight and they slipped very fast. How does an investor guard against this risk? Is it really possible to guard against this risk?
Actually, that's a very good question, and it's a little tough to answer that, but let me take a stab at it. So, actually, the ratings of a bond should ideally not change that fast. It either means that something very dramatic has happened in the corporate, or the rating agency was not able to spot it earlier and did not give an appropriate rating. So every time a crisis like this happens, the rating agencies fine tune and tweak their process to ensure that they're able to catch that trend change much sooner, so that it gives them more time for investors to take an investment decision. Now, but practically what you've seen is these can happen very fast. And unfortunately, for a lay investor, they by the time they get to know and they react, it becomes too late. So before and knowing this risk, what investors should do to prepare themselves is that right at the outset, they should invest in the right kind of bonds which are secured, which have a good rating, and also they should have that right time horizon, because often the rating can fluctuate down because the macro environment has worsened, but it can also improve. So if the investors have the time horizon and they don't need the money back so quickly, they can wait for the end of that bond to get matured to get back paid. And quite often that gets paid. The problem happens is when a lot of people want to get liquidity immediately and they start panicking, and it leads to that kind of a issue which we had seen in Franklin Templeton EMC. So yeah, but to answer your question, yeah, so they can deteriorate fast. Rating agencies should ensure that they're able to spot these much earlier and put it out in the public domain. And investors need to ensure that before entering in, knowing this risk, take care that their risks are mitigated and they have a long enough time horizon of investment.
Is it enough for investors to just go by the ratings, or should they also keep an eye on the financials of a company?
Right. So ideally, yes, they should keep a track of that as well. But having the technical knowledge to be able to do that is not very common. So yes, ratings are an indicator of not just financial information, corporate information, promoter information, business industry information. So that kind of encapsulates the whole. But as an individual investor, they should ideally look at financials and all these other factors themselves, or they need to have an advisor who does it, or they have to refer to platforms like InCred Money, where they are able to get all this information in a more succinct manner and are able to take this decision quite quickly. So ideally, yes. If not, then you should probably depend on a platform or invest in debt mutual funds, where both cases where there is somebody to help you do this kind of analysis.
Let us now talk about the liquidity risk in bonds. How serious a risk is it? What types of bonds suffer particularly from liquidity risk, and how does an investor mitigate it?
Right. So most of the bonds in India suffer from this problem, except for maybe a few AAA papers, which have a deep OTC market, which is over-the-counter market, where larger ticket sizes are transacted. But most of the time in India today, for retail investors, smaller ticket sizes, and on the stock market, liquidity is fairly low, and this is a problem. Uh, it can't be solved in the short term. Over the longer term, as more and more participants come in and there are more buyers and sellers, liquidity naturally improves. So we are going down that path. But yes, it is a challenge today. And hence, when investors, invest into bonds, they are more recommended to think about the bond tenor as the maturity period, and only then they should invest in these papers. You should not plan to invest in a 5-year paper thinking that you may be able to get an exit with a good price within a year. That should not be the way you invest in it. If you can still get it, if you're lucky, but you should look at the whole tenor and prepare for that kind of a liquidity event.
So basically match your investment horizon with the tenure of the bond.
Yes, you should do that. Yeah.
My final question to you is, what are some of the common mistakes that you see retail investors committing when they enter bonds? And what steps can they take to avoid them? Of course, we have covered a lot of ground already. Of course, we have covered a lot of ground already, but if you could summarize it.
Sure. So I think you had asked that point that one of the common mistakes that investors do is they look at rate and look at only rate before determining whether to buy a bond. Unfortunately, it's not as simple. They also need to look at the different risks that are there in the particular bond issue. And as summarized, you have a credit risk, you have an interest rate risk, and you have a liquidity risk. One thing that investors need to keep in mind is that any investment, any asset class, be it bonds or anything that is higher than a risk-free rate of about 4 to 5% has a risk in it. So the first thing that investors have to have that knowledge is that any product that gives you returns of more than 5% has some risk in it. Now the question is that, do you know what that risk is, and are you comfortable taking that risk? And they should ask questions that, how is this risk mitigated? How is this bond issue or the platform trying to reduce the risk of this particular paper? Like, for example, are you picking good names that have good pedigree, good promoter, and a lot of cash balance, like looking at their financials? Second, is it a secured bond? So is there a collateral that is backing the bond? The third is that, is it rated? Does it have an investment grade rating? The fourth is, what is the principal and the coupon payment terms? Are you going to get back your money in more frequent time periods, so that the overall risk is mitigated because you keep getting your cash back? And the last is, how is the legal paperwork documentation done? What are the different terms of the bond that have been issued? Because each bond issue also comes with a set of legal covenants, they call, and clauses that are there in the paperwork. So how strong are they? So an investor has to at least be aware that there are different factors other than just the interest rate that go into a bond investment. And as long as they are prepared for it, they should do it. Now, that doesn't mean that they should not invest and only do it, because you also need to earn returns on your investment to beat inflation. And finally, it is all about how you create a portfolio. What is your diversification? So if you have some amount of equities, you have some amount of mutual funds, you should also do some amount of corporate bonds to create a more diversified portfolio, because each one has a different risk. And then when you put all of them together in like a basket, that's where your portfolio and your returns tend to improve. So investors need to look at it from a diversification point of view, an asset allocation, and a risk mitigation point of view before determining a bond investment.
Thank you, Mr. Kuppa. It has been a pleasure speaking to you. I have learned a lot.
Thank you so much for having me.
I've learned a lot about bond investing. I'm sure our viewers will also gain immensely from this interaction. Thank you and have a nice day.
Thank you. Thank you so much.